So you don't think the highs are in yet for the S&P 500?
No, I think we're probably, it's interesting. Everyone's looking for a crash in January or February because we ran too far, too fast, so to speak, in the last 9 or 10 weeks. And what they fail to realize is that or pay attention to, we like to zoom out. The market has made zero gains in the last 2 years.
Thomas Hayes is back. He is a managing member of Great Hill Capital, and he'll be talking to us about his outlook for 2024, which assets will perform the best, what will happen to the stock markets, and what will happen to Fed monetary policy. Thomas has been on the show prior in 2023, having made a number of correct calls, including the fact that the S&P 500 and the other stock indices will continue to grind higher, and the fact that the Federal Reserve will eventually loosen monetary policy. Both turned out to be correct calls. I'll put links down below so you can see what we've talked about in prior sessions earlier last year. But first, a word from our sponsor before we get to Thomas's new outlook. I Trust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. It also has unique tax benefits. So if you're over 18, you want to roll over an existing account or open a new account with cash, click on itrust.capital/David in the link down below to get started. Thomas, good to see you again. Happy New Year. Welcome back.
Thanks for having me, David. Happy New Year to you as well.
Your fund has had an extraordinary year last year. You were telling me offline. And by the way, people should watch our prior episodes. I'll put links in the description down below. And your calls for the equity markets to grind higher and just generally speaking, the markets to perform well towards the end of the year. Those have been very, very, very spot on calls. You've also called for the Fed to eventually start easing, which now they're starting to do. Let's start with that, actually. Let's start top down. Monetary policy first. So just in today, Atlanta Fed President Raphael Bostic expects policymakers to start cutting rates in the third quarter of this year, saying Thursday. This came in from CNBC. Now, third quarter of this year is a little bit farther out than what markets are pricing in. The CME Fed Watch tool is pricing in a cut by March. Where do you stand?
Yeah, originally I was in that camp where it would be the second half of this year. I was pretty adamant that they'd stop hiking, and that certainly came to pass. I do think when you look at core PCE annualized, it's now at the the Fed target, and you have the Fed funds rate at 525, 550. That's over 300 basis points of restrictive policy. So I think, and then the other thing, you look at the non-farm payroll reports, 10 out of the last 11 months have been revised down to the cumulative tune of 500,000 jobs were over-reported. So I think when you sit back, inflation is a much easier problem to solve than deflation. And if they're too cavalier about the lagged effect of all the aggressive tightening they did in such a short period of time, they may wind up having to do far more cuts than they would have anticipated. So I think the moral of the story is, the earlier they get started, the less cuts they'll have to do. I think their analysis that they could potentially get away with 3 cuts is much lower than the market's analysis of expecting 5, 6, 7 cuts. I think if they started in March at the latest on that 3-cut plan, that may be all they have to do. I think if they delay it, like Bostic was referencing today, then they may have to do a lot more, which would imply a soft recession coming. We are not in that camp. The other tool that they have that no one's really paying attention to, that I think we're going to hear a lot about on January 31st, is going to be tapering the taper. They may be able to get away with delaying cuts if they stop selling massive amounts of bonds on the open market to restrict policy. So get rid of quantitative tightening first, and that may buy you a few additional months from when you have to start cuts.
I think the key here is market expectations versus what's going to happen. So you brought up the fact that the markets are expecting 6 to 7 cuts potentially. If you look at the economic data, though, Thomas, what do you think is likely to happen? In other words, does the data suggest a divergence from expectations which could move the markets?
It's Goldilocks. I mean, when you look at earnings estimates for 2024, up 12%, 245 on the S&P 500. The one aspect that people aren't pricing in is margin expansion. you had 2023 was a year where every CEO was preparing for a recession that had already happened in 2022. Very few people acknowledge we had 2 consecutive quarters of negative GDP growth, first and second quarter of 2022. So the recession and the cuts that they made and the efficiencies that they put in place in 2023 in anticipation of a recession are still there. And that's why you see expectations now for 50, 60 basis points of margin expansion for companies, as well as 12% earnings growth. Even looking at Q4 earnings, they were expected to grow at 8% just on September 30th. Those expectations are down to 1%. So that's not a bar that needs to be jumped over. That's a bar that can be walked over. And as I always like to say, the secret to happiness is low expectations. So I think we're going to see, as earnings move on, positive beats and some decent guidance, which should continue to create some support for equity markets in 2024.
So you don't think the highs are in yet for the S&P 500?
No, I think we're probably, it's interesting. Everyone's looking for a crash in January or February because we ran too far, too fast, so to speak, in the last 9 or 10 weeks. And what they fail to realize is that or pay attention to, we like to zoom out. The market has made 0 gains in the last 2 years. So we had the big rally off the COVID lows into 2021. But since late 2021, we're now going on over 2 years of 0% gains. So as is normal, and we've seen since 2009, 4 other times where you have these, year and a half, 2-year consolidations with no gains are followed by consistently by rallies of 1.5 to 2 years. And I think that's probably where we are now. That doesn't mean we can't get some chop in the early part of the year, but I think we're actually going to bust out and make new highs before we see some weakness in probably late February through kind of the March period, after all of the last remaining bears that are still hating every step of this rally, which has been monstrous, not just off October 2023, but off October 2022. And I know we were talking about buying semiconductors and tech with you back then when you couldn't give away tech. So I think we got to bring in finally those last bunch of people that have no credibility with the bear argument. We got to bring them in. We got to flip them, maybe 3% up. New highs, 4% up new highs, and then shake everyone out in March or April before we finally have the year end. But in the context of 2024, we are looking for high single digits on the indices, low double digits, because that would be consistent with the average election year performance since 1928 of 11.28%. And when an incumbent president is running, average performance of 13%.
Well, sentiment does seem to be improving. So in your newsletter, great newsletter, by the way, I'll put a link in the description down below, hedgefundtips.com. You've covered recently the Bank of America Global Fund Manager survey results, and you've just highlighted a few charts. I'll share with the audience here a few charts that you've highlighted here. The first one is net percentage of FMS investors who see a stronger global economy in the next 12 months. So it was pretty bleak all throughout 2020, as you know, steady incline upwards, still in negative territory. So I'm not sure exactly how you would interpret this chart. Sentiment does seem to be improving as the trend. Is that something that you've noticed in your everyday life as well?
Yeah, well, opinion follows trend, right? The price has gone up. We're now breaking out. Everyone's like, oh my goodness. But I will say these are barely coming off the mats. Even if you look at global corporate profit growth outlook expected to improve, that's still negative, as well as to what you pointed to, stronger global economy in the next 12 months. It's literally coming off 2009 low levels. COVID low levels when we didn't even know where we were going to get a vaccine. In both of these cases, that's the level of pessimism. You can't make this up after 9, 10 weeks straight up. So again, we got to flip those people. I think this could flip positive very, very quickly. Part of that will likely be dependent on the Fed's rhetoric on January 31st, as well as the continuation of earnings season beyond banks. And once you get that exuberance and we break out to new highs, 3, 4, 5%, I think that would be an opportune time that the market comes back and retest the breakout level before pushing higher into year end. So a lot of noise with geopolitics and the election and everything else. But on balance, companies are in good shape.
Well, let's just talk about that. What are the major risks that you would be eyeing?
I think the biggest risk is that Jay Powell worries too much about his legacy and he gets trapped in this false analog of Arthur Burns in the 70s, comparing the double peak to present conditions. And present conditions are nothing like what we experienced in the 70s from a demographic standpoint, from an economic standpoint, from an energy production standpoint, from a geopolitical standpoint. So if he stays this tight, 300 basis points too tight for too long, he could tip us into a recession, which basically, if he does that, and that starts to be apparent by September, October, Trump guaranteed to win the election. I think that if he gets easier earlier, odds favor an incumbent president getting reelected in the absence of a recession. But if he pushes us into recession, he gives the world Trump, and if he kind of starts to ease, which is what he should be doing, the odds are on the incumbent. I don't talk politics either way, but I'm just saying those are the historical likely outcomes of what can happen on the basis of monetary policy. And I'm sure they're cognizant of the political ramifications, but in terms of what they should do from an economic, non-political, apolitical standpoint, is they need to remove some of this restriction quickly, or they are going to push disinflation, which we're already seeing, onto the brink of deflation, which would cause a recession that is not needed nor wanted.
What causes deflation? Too much easing? Too soon?
No. Deflation would be caused by keeping rates too high for too long and ignoring the lagged effect of what they've already done. One of the steepest hiking cycles in over 40 years.
Right. Okay. But they've already signaled that they have an intent to cut. So we're talking about an event that is outside their expectations as well, right? That will push them to keep rates higher.
That is correct. So on days like this, where you get a decent jobs number and the yields creep a little bit higher, and everyone worries that they're not going to cut, I think these are fake out. I think this is noise. I think, to your point, their intention is to cut. Now we're just talking about timing, March or the meeting thereafter. But sooner, the earlier they go, the less they'll have to do, because there is an underlying strength. It could be just a mid-cycle tempering the restriction that they have in place versus having to go full tilt easy back again to this normal up and down cyclicality where they take rates all the way up, then they wind up overshooting. They have to take them all the way down. They could probably keep them at a normal cost of capital if they're prudent about getting out of this restrictive mode soon enough.
Okay, this is an interesting chart. Same report. For the first time since June 21, large caps expected to underperform small caps. And this chart illustrates that the percentage of managers interviewed or surveyed think that large caps will outperform small caps is lower. Where do you stand on this? Small versus large. Yeah, you agree?
I agree. On the basis of the indices doing, high single digits to low double digits, which would be normal for an election year, what that implies is the Magnificent Seven underperformed, certainly relative to what they did last year. And the real opportunity and the real value and the real performance is going to be found under the surface. If you look at forward earnings on large cap, i.e. the S&P, you're knocking on the door of 20 times forward, which is high historically, particularly when the Fed funds rate is this high, versus small and mid caps knocking on the door of about 14 times forward. So that's where you're going to find your relative value. That's where you're going to see the outperformance relative to what is actually, you referenced the Bank of America survey. The most crowded trade is the Magnificent Seven. That doesn't mean it won't stay crowded, and it can't stay crowded for a long time, because before there was something called the Magnificent Seven, there was FANG, and that was crowded for a very long time. But I think they'll perform just fine. I mean, we own Alphabet and Amazon off of the October 2022 lows when you couldn't give those stocks away. Unfortunately, we didn't grab Meta, and that one was a rocket as well. But we expect that portion of our portfolio to underperform, but we have no intention of selling those anytime soon. We think they'll break out over time. But as far as new money put to work, we think they're unique opportunities. Some beaten down turnaround opportunities, but then if you look at the fund manager survey from yesterday, managers are between 0.2 to 1.1 standard deviations below their historic average holding in banks, real estate, commodities, UK equities, and even energy. And I think there are discrete opportunities in each of those spaces as well.
If you zoom back, or zoom out rather, and just take a look at the Russell 2000, going back to 2022, over the last a year and a half, almost 2 years, it's just been range bound, chopping sideways. Why is it that you think the mid caps and small caps have had a harder time breaking out? Obviously, we know about the Magnificent Seven, but something held them back. What was it?
Yeah, it was 100% solvency risk. So capital markets for refinancings were closed for basically throughout most of the tightening cycle and since the tightening cycle. So the ability of companies to refinance was non-existent. Then it was existent at very high rates. And now the market's starting to price in that they will be able to refinance at lower rates. And that's why you're starting to see some buoyancy in small caps. And then you also had, what is the weighting? The weighting is financials and is energy. In terms of financials, the real risk was the bond portfolio, not the credit portfolio, but the bond portfolio. Because of the COVID stimulus, they had record deposits and they were forced to put money to work at the exact wrong time when money was, cost of capital was zero. So they had to buy, they wanted to be safe. They're like, how can we be safe with all this deposit money? We got to reinvest it. Well, let's put it in treasuries. Well, little did they know, even the ones that were out 5 to 7 years got smoked because Powell came in after buying bonds in the face of inflation and overshooting on the other side, then the steepest hiking cycle in over 40 years, and it blew up their portfolios, and they were underwater on all the mark-to-markets for their portfolio. So as bonds have rallied in the last several months, those mark-to-market and balance sheet marks have improved as yields have started to come down and bond prices have gone up. So now small caps can start to perform because those banks are in a better condition. Also, deposit flight has alleviated as the deposit rates start to become slightly more competitive relative to what they could get in T-bills. And as people sniff out Fed is going to cut, more and more money will come out, and will also start to come out of money markets, which is currently $8.8 trillion. It's interesting, early last year, everyone was pounding the table. It's a no-brainer. Why would you take any risk when you could get 5% doing nothing? And I like to think about what is the pain trade. So I said to myself, well, how can the most people get hurt, which is the pain trade at any one point in time? And I said, well, they can't get hurt if rates keep going higher per se, because their bonds will mature within a year. So they might have some temporary unrealized losses. They won't get hurt if bonds rally because they've already locked in that rate for 12 months. So how would they really get destroyed? And the only way they could have gotten destroyed is if equities dramatically outperformed 5%. And what did you see on the S&P 500? Mid-20s. So everyone who went for the obvious trade got smoked. And what's the obvious trade right now is Magnificent Seven, AI narrative, the whole thing. And again, I think Magnificent Seven is going to do fine. I just think it's going to be I think it's going to be deadish money relative to some of the opportunities that we've discussed in small and mid, and maybe ex-US as well.
Let's talk about the tech stocks for just a minute. Layoffs are continuing just today. Google announced more cuts following Amazon and other companies like Twitch, for example. So are these company-specific layoffs that we're talking about, that just people cutting the fat, making themselves more efficient, or are we seeing a wider systemic issue in the labor market?
I think this is, you had basically a year of efficiency in 2023 for tech companies after they got smoked in 2022, and that is starting to wind down, number one. Number two is they're talking about AI leading to greater productivity. That is deflationary, and as we increase productivity through AI and through other technologies, that's deflationary. So I think what happened is you saw massive overhiring in COVID. People were paying any price for any warm body in the tech industry, and they're just kind of reverting back to the mean. And this is the tail end of that, largely speaking.
Okay. The ISM manufacturing survey, PMI index at 47.4. It's below 50, which is contractionary, not expanding. Is this a concern for you?
Manufacturing has been in a recession for over 24 months, so it's not news. I think that'll be the laggard to start to get back into expansion. But we have had rolling recessions, whether it was tech in 2022, manufacturing all throughout the process, and we've managed through it. So I think on balance, this is a great example of Goldilocks. Not too hot, not too cold. You have tech running hot now, but you have manufacturing running cold. You had banks running cold last year. Now they're starting to recover as their mark-to-markets recover. You had credit markets closed, forcing solvency risk on a good portion of the small and mid-cap universe. Now credit markets are opening and pricing in lower rates moving forward. You had people unable to buy a new home last year because of mortgage rates. Well, those are going to start to come down, and even the slightest ticks down, you're seeing huge jumps in mortgage applications. So I think that's going to persist into 2024 as well. I think what we need to step back again to zoom out, David, is the fact that it's very hard to get bearish when you have the vast majority of your population age 33 to 34. If you look throughout history across the world, any major country or economy that had the bulk of their population at 33, 34 had a tremendous economy and stock market up until they started to exceed 40 years old in mass, because those are the core years of family formation, housing formation, consumption. You move from the city to the suburbs, you have to buy a car, then you have to buy a second car, then you have to buy a crib, then you have to buy a washing machine, refrigerator, couch, et cetera, et cetera, et cetera. And you know the story. And you can trace that throughout the last 100 years. The last two major secular bulls of 48 to 68 and then 82 to 2000 were all precipitated by having a bulk of our population in that demographic. And right now we're about halfway through that 18-year cycle. So we have some normal mid-cycle consolidation, which we had in 2021 to 2023. And now it looks like we are going to resume the uptrend in coming years.
Let's close off this discussion on positioning for 2024. So we talked about large caps versus small caps. We talked about the economy. Which sectors in particular do you like most, Thomas?
Well, I like discrete idiosyncratic opportunities. And the first one I want to talk to you about is PayPal. You know me long enough. I love stuff that's high quality but beaten up and out of favor. PayPal's down 80%, and the catalyst now is a new CEO, Alex Chris, who came from Intuit. He was responsible for the small business unit at Intuit, 50% of the revenues during his tenure. The stock was a 38 bagger, went from $18 to $707. So basically what he's going to do, he's only been in since September 27th. He's having a major conference call on the 25th of January. He says he's going to shock the world, end quote. We revolutionized the payments industry 20 years ago. We're going to do it again. The interesting thing is to have a stock down 80% from its recent peaks. You would think there's solvency risk, there's declining revenues, declining margins, negative cash flow. Just the opposite is true in every single instance. The key thing is it's the multiples re-rated. It used to trade at 30 times because it was a perceived growth company. Now it trades at 12 times forward because it's a value company. And his growth plan, which he laid out in the last couple of months, is to get back to a growth company and profitable growth moving forward. So they just fired millions of customers in Latin America that were non-profitable. They still have 428 million accounts around the world. And the other reason they got derated was they have a business called Braintree. A lot of people say, when's the last time I used PayPal? Well, when's the last time you took an Uber? Because they have the Uber account through Braintree. That's the white label business. They have Ticketmaster. They have Adobe. They have Booking.com. And the problem with that business is the margins were contracting. And because they were the bulk of the volume, they took the overall company margins down, even though cash flow is improving, earnings are improving, revenues are improving. He said on the last call that he believes Q4 was the inflection, and they've added value to customers that they can now start to gain price in addition to share. Currently, that business has 500 billion of the $5 trillion global enterprise business around the world, which is about 10% of all global transactions on the white label. And then on the PayPal and the Venmo has become a verb. So they now have Venmo Teens. They're going to roll out that business and that branding even bigger and better. And I'll be very interested to see what he has to say about data and AI on the 25th. I think we're going to be positively shocked and surprised. And all you need when you have growing cash flow, when you have stabilizing margins, when you have growing revenue, all you need is a catalyst to re-rate the multiple. And I think that's going to be imminent, if not on the call on the 25th, then as we see earnings over the next couple of quarters, and he implements the plan that he's laid out in the last 3 months.
Your company's made it when the name has become a verb. Yes, but good points. What about fixed income with rates expected to fall? How do you feel about bonds?
Bonds we were interested in September, October. We actually bought TLT, a very simple way to express it. We think they've taken a breather, but we do think that the trend is going to be up, meaning lower yields and higher prices for the 10-year and beyond. So, but we had the biggest amount of the move in the shortest period of time in the rearview mirror. So we'd rather express it a different way through some of the dividend stocks that have been left behind. We've had, we have Citi, which we wrote about in this week's article. We had that from the low 40s. Generac, Stanley Black & Decker, all these companies that over-purchased inventory during COVID have worked through that in the first, second, and third quarters in 2023, and now are getting back to well-oiled machines, just throwing off huge amounts of cash. They're all starting to recover, and some of them were up 40, 50% in the last 8 weeks of 2023, and they're going to persist higher in 2024. And those are the areas that no one's looking at. So we would play bonds through kind of bond proxies or dividend stocks that have been part of the mediocre 493 versus the magnificent 7. And I think that the opportunity is going to be in the mediocre 493 moving forward.
And finally, any other asset classes outside of bonds and stocks that we've discussed that potentially could do well, in your opinion?
Well, this is not our game, but I would be long non-US dollar. So emerging market currencies relative to US dollar, China yuan relative to US dollar, Japanese yen relative to US dollar. I think that the dollar downtrend that began, call it October of 2022, and has had a few fits and starts and counter trend moves. We just recently had a counter trend move, is going to resume its downward trajectory. And on that basis, you can be long euro, Canadian dollar, Australian dollar, yen, yuan, and the like. And that sets up a whole different regime of opportunities, particularly emerging markets and many of the companies that have been left out in the cold. Excellent.
Thomas, where can you follow your work and read your insights?
Yeah, I think I'm most outside of managing money for clients at Great Hill Capital. I'm most well known for the podcast Hedge Fund Tips with Tom Hayes. You can watch it, the video version, because we do a lot of charts at YouTube. Just type in Hedge Fund Tips with Tom Hayes, or anywhere you get your podcasts, you can listen, Apple, Spotify, etc. And then our website, just put your email in and you'll get all that emailed to you on a daily basis at hedgefundtips.com. On the right-hand side, you'll see a place to stick in your email. You can unsubscribe at any time, but those are the best ways to get a hold of us.
We'll put the links down below, as well as the links to our prior interviews, Thomas, so people can know just how good you are. Thank you very much.
Well, thanks so much, David. I appreciate it.
Thank you for watching, and don't forget to subscribe and like this video.